On board Stephen Innes. He's managing partner at SPI Asset Management, joining us this morning. Great having you here, Stephen. First, let me start off with that US CPI print and what one can expect from it. Upside surprise, or rather a downside risk at all is what you see on that print. Do you expect CPI to come in higher than expected?
I think the unquantifiable risk is actually the impact of AI in the economy. It's been driving huge amounts of uplift into gross domestic product. If we look under the hood there, most of the price pressures coming out of AI, such as token costs, are not really picked up by the index correctly. So it's going to be a little bit interesting how we quantify this. Sure, we've really built in the fact that oil prices are going to be driving the price structure higher. But what's behind the scene here? What are the quants looking at? What are we actually trying to figure out from this AI expansion, and whether this is going to be the next inflation flame? Obviously, if we have anything above 4.2, it's going to be quite negative for the markets. But historically, even a breach of 4% has been quite negative for US markets in general. I mean, it's just going to lead into a more hawkish Fed narrative. And this is a bit of a problem. You know how modern day markets have operated post-COVID is that basically, higher interest rates are just negative for stocks. Good news is actually bad news because the market lives off lower interest rates. And it kind of makes sense because of the growth assets and the lofty valuations. They really need that lower interest rate to improve forward momentum when valuations are so stretched and so high.
Can you also give us a sense of what you make out of the current correction which is happening in many of the semis and AI stocks at this point in time? There's a big IPO underway in the US SpaceX, which is going to list on 12th. Are you seeing a churn of within the AI portfolio and moving to the IPO as well?
Well, 100%. That's going to be built in. The biggest question we have right now is who's going to be paying. We've got 4 times oversubscribed on the SpaceX IPO, and that sounds great on the surface. But the problem is, strip away everything, and you just look at the institutional leverage who's going to be backing this up. It comes down to the very fact who is going to pay for it. I mean, there's only so much cash out there in portfolios, and quite frankly, we're going to have to be selling some of these structural top-end winners to pay for the wave of IPOs coming out. That's one of the things we're looking at, and it could really be a toxic cocktail if you figure it out. We have this even more hawkish Fed outlook after last Friday's meltdown because of the hawkish Fed on the strong U.S. payroll number. What if we get another one ahead of these IPOs? So it could be in for a little bit of a nasty correction, given the volume of stock issuances that come to market. And once again, defaulting to history, we usually see a nice uptick in the stock in day one IPO, but then the sellers come in, whether it's insiders, whether it's just profit takers who were in pre-IPO. There's usually the big wave. And defaulting back to the other factor that we're looking at, it's the churn, it's the flip, it's the rotation out of the winners to fund this stock. So we're going to be in for a little bit of messy week, I think. And I'm not expecting a big bounce in stocks coming over the next week or two because of this super amount of issuance coming to markets. I think it's just going to clog up the system.
And Stephen, give us a sense of how you're looking at the Fed funds rate going. Probably rate hikes is what you're expecting, maybe. And what's the kind of terminal rate at the end of this year that you're expecting? What should the rate be?
Yeah, I think the 4% horizon is definitely coming into the charts again. But one of the bigger issues is the wild card here is Kevin Warsh. I mean, what's he going to be leading the Fed towards? Obviously, if we have a high CPI, there's absolutely no way he's going to fulfill any hawkish political hawkish lean, because it just ruined the credibility of the Fed. So we'll have to really see how the FOMC comes together in its first meeting. I think we'll get a better feel for how the FOMC is leading in the statement. But the big thing that the market will be looking at, obviously, is removing the the easing bias that's been littering the tape, littering the the comment or the follow-up report for the past couple of prints, when arguably the bias in the market sense is towards hiking. So whether that's priced in or not, we always think it's priced in, but how the market reacts is really going to be the determining point. To me, any hawkish inference is negative for the market. So I think the market will react negatively.
Stephen, is the debate on, because the rate cut debate is not there, is it on pause or when to hike, and the kind of commentary which now the street is betting on?
Yeah, well, I think that's why the street is leaning. And even the interesting part, it doesn't even have to be through the rates. It's the implication of the way the market structure is looking at it. So if the market is leaning hawkish, it's negative, regardless of whether the Fed is leaning hawkish or not. So we have to take that into consideration. But there's a lot of asymmetry in the tape. There's obviously, if oil comes off a little bit more, that's a very positive thing for the inflation outlook. It may keep the Fed on hold a little bit longer, but certainly we're going to be in a higher for longer regime. Now, when everything settles down, and we look at the AI boom objectively and how this is going to evolve over the next decade, I'm not saying that we're in a market crash scenario. I'm just saying there's a lot of clogged arteries coming up for over the next few weeks. And I think this is why investors need to be a little bit cautious, not necessarily cautious over the long term, but cautious over the short term, that their portfolios may suffer a little bit of staggering defeat here, whether that means rushing out to buy, which has now become expensive downside insurance. Perhaps, some of the things we were looking at a couple of weeks where insurance was rather cheap, perhaps we should have been a little bit more forceful with our clients to have them buy some downside protection when we were buying downside protection ourselves. But they didn't really seem inclined to do that because they were all caught up in the FOMO of the AI trade. So it's one of these learning lessons I think a lot of investors going to be taking a look back at, and certainly why they didn't cover some of the downside risk going into what was arguably going to be a hawkish Fed. And that was on the table probably 2 weeks if you were looking at the strong US economic numbers, and the US surprise index was beating all expectations.
It seems that in this entire AI trade or macroeconomic, data which is expected, we have not discussed the West Asia impact. It seems the markets are discounting it altogether, like a Russia-Ukraine war, and it's going to go on the sidelines, but the markets will go on its own route.
Well, here's the thing. The market had convinced itself that AI was deflationary. And that may very well be proven over time as productivity increases. But when you look at what's ahead, the buildup that's going to actually create that deflation, it's actually inflationary because there has to be a lot of structural implementations, infrastructure implementations, whether that's data center, whether that's whatever, and that's going to require commodities, and that's going to be expensive. The other problem is chips themselves. The reason why chips are rallying right now is not because there's lots of them out there, it's because there's limited supply versus the huge amount of demand. I mean, the whole AI craze is just making the market go hotter and hotter. And what we're seeing on token prices, that's the actual price you have to pay to actually use them, is ginormous. Myself, who uses AI to build market models now, is constantly having to fill up the tank when I'm using Claude. And that's becoming a worrying thing. I mean, I'm only a little guy here. What are the big shops doing when they're consuming massive amounts of AI electricity and tokens? And this is going to eventually spark some inflation, in my opinion, without any doubt. But here's the but. We don't have the models to determine it. And I think this is the next leg of the trade here, is that over the next year or two, markets are going to become increasingly more focused on AI indexes, whether that's productivity indexes, whether that's expansion indexes, whether that's inflation push-through indexes relative to the AI build. These are going to become more common nomenclature in the market's understanding, in my view. And we're actually working towards those areas right now because we think it could create a next inflation buzz. And obviously, that's going to be another issue. But besides what I think oil prices are going to remain sticky because even if we do a peace deal, that doesn't necessarily mean oil is going to come flowing through the Strait of Hormuz in gusto. So we could be seeing higher oil prices mixed with higher inflation coming from AI for the next, it could be the next 6 months to next year and perhaps even longer.
Right. Okay. Thank you so much, Stephen, for coming in and giving us that perspective early this morning. Always great having you.
Thanks for having me.
All right.